It's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out. Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills. Those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50%.
JP Morgan Private Bank. Gold is expected to continue reaching new highs with a mid-2026 price outlook of $4,050 to $4,150 per ounce. According to Jitong Finance APP, Chen Weihang, global investment strategist at JP Morgan Private Bank, stated that the outlook for gold prices by mid-2026 is $4,050 to $4,150. It is expected that gold will continue to reach new highs in the future. Chen Weihang noted that although Federal Reserve Chair Jerome Powell's remarks did not provide a clear timetable for future interest rate cuts, the bank still anticipates that the Fed will continue to cut rates if the U.S. economic conditions weaken further. Gold typically performs better in a low interest rate environment because lower yields reduce the opportunity cost of holding non-interest-bearing metals. With gold's recent rise, investors may consider gaining better entry points through structured products. Previously, Federal Reserve Chair Jerome Powell stated that the current policy stance is moderately tight, allowing the Fed flexibility to respond to economic needs. However, Powell also pointed out that potential deterioration in inflation and employment could bring two-way risks, and there is no risk-free path for the interest rate outlook. The remarks of other Fed officials were not entirely consistent with Powell's. Goolsbee of Chicago believes that although the neutral interest rate should be lower than current levels, the Fed should remain cautious going forward. Bowman, on the other hand, took a more dovish stance, warning that the Fed should act decisively to avoid falling behind the economic curve. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
And gold futures up $50 to 38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Done again, I mean, it's moving at a clip that just seems to be defying gravity. And now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. You know, we talked about the chief investment officer of Morgan Stanley, shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills. Those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50%. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought them. Prudential is who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take yet. Now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice.
Silver price rockets from $42 to $46 on short squeeze momentum. Silver has delivered one of its most impressive performances of 2025, with prices rocketing from $42 to $46 in just 7 trading days. This sharp move caught many traders off guard and demonstrates the volatile nature that makes precious metals both exciting and unpredictable for investors. The recent price action shows all the classic signs of a short squeeze in motion. According to analyst Burak, when bearish traders get caught on the wrong side of a breakout, they're forced to buy back their positions at higher prices, which only adds more fuel to the upward momentum. This creates a self-reinforcing cycle where each wave of buying pushes prices even higher, forcing more shorts to capitulate. The speed of this rally has been particularly noteworthy, with silver gaining nearly 10% in such a compressed time frame. This type of aggressive move often indicates that significant structural changes are occurring beneath the surface of the market. Multiple factors have converged to create this perfect storm for silver prices. The primary driver appears to be short squeeze pressure, as traders who bet against the metal were caught off guard by the sudden breakout and forced to cover their positions. This technical factor has been amplified by broader macro demand for safe haven assets as investors seek protection against persistent inflation concerns and currency debasement risks. The current trajectory has silver pointed directly at the $50 psychological barrier, but history shows that short squeezes often lead to volatile corrections once the forced buying subsides. The key for sustained momentum will be whether buyers can maintain control above the $45 level, which would suggest genuine demand rather than just technical covering. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
To your show, and he was talking about the lid coming all the way off. Is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So, yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system. Because in my mind, as much trouble as China is having, their yuan gets saved by gold. And the dollar, without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia. You'll have the vaults in St. Petersburg, of course, in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out.
What do you think of his take? Do you agree with him? Is a big rally coming for gold and silver before a big top forms, or will gold and silver outperform all expectations? Let us know your honest opinion in the comment section down below. Smash the hype button if you enjoy our recaps, and check this video right here because you'll love it. I'll see you on the other side.